So when you're looking to sell your business, it depends on what you're selling. If you're selling, let's just look at it two different ways. Number one, let's just say you're selling your rent roll. So whether you're staying in sales, whether you're winding down and shutting up shop, whatever it may be, if all you're doing is putting your rent roll on the market and nothing else, and another agency is going to buy you, they're not going to care about your general overheads for your rents and your office costs and all this because they're not taking that; they're just taking the rent roll. So in that space, it's really important to have a profit and loss for your business, specifically on the rental department. So when someone's looking to buy your business, often what will happen when we're looking at a purchase scenario, Kylie, you're buying a rent roll and you've come to me for finance. I take your profit and loss statement and I look at the rent roll income and I add that on top and that adjusts your profit up. And then I subtract any new costs, things like new property managers plus super and whatnot. If you've got a junior office, that sort of stuff, we then subtract that off the top. But if they're rolling that in, all they care about is the income and the outgoing regarding profit, the property managers. So you want to make sure that you have a specific siloed property management one so they can see exactly what's gone on with the rent roll. If they go, oh, there's office costs, we'll get rid of that. We'll get rid of because it's not, they can actually see how it's performed as a rent roll, as a property management department, and they know they're going to bring on a profitable asset. So that's really key there.
Welcome back to the Property Management Podcast. Thank you so much for being here. And today's episode, I feel, is one that every property management business owner needs to hear because we're diving into something that can completely change the way that you run your business. And that's understanding what your financials actually mean. Because let's be honest, if you're anything like me, you stick your head in the sand when it comes to numbers. And so many people in our industry, they're busy, they're growing, they're working hard, but not always clear on what their numbers are actually telling them. And the difference between a business that feels successful and one that actually is financially strong comes down to a few of the things we discuss in this episode. So I'm really excited for today's conversation because I'm joined by Travis Whelan. Travis has over a decade of experience working within the real estate space through Westpac, specializing in rent roll finance, and he has worked with portfolios ranging from 150 right through to 5,000 properties. He now has his own business and he brings a really unique perspective, not just understanding the numbers, but understanding what they mean behind the scenes when it comes to growth, acquisitions, selling your rent roll, and the overall strength of your business. And what I love is that Travis genuinely understands our industry. He grew up in real estate. He's seen firsthand the impact great agents and property managers can have. And he knows that a strong rent roll isn't just about size. It's about structure, performance, and financial health. So in this episode, we're breaking it all down, what you should be actually looking at in your business, the common mistakes people make when it comes to their financials, and how understanding your numbers can help you grow, scale, and make better decisions with confidence. We also talk a little bit about the tax situation that a lot of us often get into when it comes to running our businesses. But most importantly, we tell you how to avoid getting into financial strife with the ATO. There's a whole lot of other stuff we discuss as well. So grab your cup of coffee, grab your note, pen and paper, and let's dive on in to this episode. Travis, thank you so much for joining me on the Property Management Podcast. Before we dive in, can you share with our audience a little bit about yourself and what you do?
Yeah, thanks for having me, Kylie. So I've been in banking and finance for about 16 years now. So I fell into it as a graduate a number of years ago. And then after a couple of years of working my way through the bank side, I ran into a couple of people who specialized in real estate and property services banking and went on a few years of a journey in that space and then found myself writing rent roll transactions through one of the major banks. And a couple of years of doing that in the small business space, moved up into the commercial space. And then after a couple of years of doing that, I decided to go out on my own as a broker and launched the rent roll finance broker in 2024. I've been doing that for a couple of years in addition to another mortgage broking business that I hold. So the whole idea of the rent roll finance broker is that we specialize in providing finance solutions against rent rolls to help business owners grow their businesses, to restructure their businesses, to help with buy-ins, sell-outs, buying commercial property, those sorts of things. All the things that you can do with your rent roll. There's so many people in the industry don't understand. And I see part of that role as education. So that's where we are today.
Amazing. I've just gone through the process of selling my rent roll. I wish I knew back then what I know now. And I am also in the process of buying a house at the moment. There's a lot to financials and finances when it comes to setting yourself up either for a sale or either to buy a rent roll.
Yeah.
In your opinion, and you've worked with obviously lots and lots of businesses and property management and real estate businesses now, what do most business owners not understand about their financials?
What they actually are and how they actually interact with their daily business. So the biggest thing that I see around the financial data, and it's not just real estate, but all industries, would be the difference between cash accounting and accrual accounting. So a cash accounting is where you account for it here and now on the dollar when it hits your account, when you not when you bill or when you receive a bill, but when it actually transacts out of your account. So that's how one set of financials is done. The other one is your accrual accounting. So when you issue that invoice, it sits on your profit and losses income, but it won't sit on your cash accounting profit and loss because you haven't received it. And that causes a lot of friction, believe it or not. When we're going to get finance for clients, they show me a profit and loss that says, hey, I've got $200,000 in income, which could be your accrual base because you've issued your invoices. But then your accountant converts it for the tax man, so you pay less tax on your cash accounting, and therefore your profit's now 50 and you can't get finance and you're wondering what's going on. There's a whole bunch of things between profit and loss, balance sheet, cash, and how they all interact, which really affect an application process in all finances, but specifically around rent roll transactions, about when you're invoicing and all that sort of stuff as well. So that's probably the biggest thing around the financials, is that interaction between the numbers and how it works with your daily business.
Yeah, and you need one set of numbers for when you're running your business to look good. And then when you're going to sell your business, you need to flip that around and have your other numbers looking really good. And it's the same for when you're buying a
Yep.
house as well, which makes it really difficult. So I guess that's where, for any business owners that are thinking about selling, what are the numbers that they need to be focusing on right now or leading into, would you say 6 months or 12 months into selling their portfolio? And then we can flip that and then say, if you're looking to buy a rent roll, what are the numbers that you want to be looking at?
Yeah, absolutely. So there's a few different aspects of that. So when you're looking to sell your business, it depends on what you're selling. If you're selling, let's just look at it two different ways. Number one, let's just say you're selling your rent roll. So whether you're staying in sales, whether you're winding down and starting shutting up shop, whatever it may be, if all you're doing is putting your rent roll on the market and nothing else, and another agency is going to buy you, they're not going to care about your general overheads for your rents and your office costs and all, because they're not taking that, they're just taking the rent roll. So in that space, it's really important to have a profit and loss for your business, specifically on the rental department. So when someone's looking to buy your business, often what will happen when we're looking at a purchase scenario, it's, Kylie, you're buying a rent roll and you've come to me for finance. I take your profit and loss statement and I look at the rent roll income and I add that on top, and that adjusts your profit up. And then I subtract any new costs, things like new property managers plus super and whatnot. If you've got a junior office, that sort of stuff, we then subtract that off the top. But if they're rolling that in, all they care about is the income and the outgoing regarding profit, the property managers. So you want to make sure that you have a specific siloed property management one, so they can see exactly what's gone on with the rent roll. If they go, oh, there's office costs, we'll get rid of that. We'll get rid of, because it's not. They can actually see how it's performed as a rent roll, as a property management department, and they know they're going to bring on a profitable asset. So that's really key there. On the flip side, if you're selling your whole business, including sales department and the lease, they're going to take over that jazz, which does happen in different states versus, say, Victoria, where most of them seem to be just the asset sales because of there's notice of reassignment clauses and whatnot. But other states don't have that. They've got to sell the whole company, which often then comes with leases and businesses and whatnot. With that one, you want to show your full profit and loss to be strong, because the bank isn't just going to go, okay, you've got a good rent roll, tick. They're going to look at your entire department. So if you're selling your whole business and your sales team with it, they're going to look at how have you run your business? What's the profit? Is it profitable? Are you charging properly? Have you got good sales staff? They might even ask you to split departments, property management and sales, to see how each of them are going. But overall, the whole thing needs to be looking pretty schmick, because the bank of your purchaser is going to be asking for those to help service that debt, to take over your business. The timing of those, you really want to make sure in an asset sense, if you're selling the rent roll, 12 months, 2 years would be tops, specifically just because we're buying an asset. We're not buying a trading business. So it's very much siloed to that asset with a couple of adjustments. But if you're selling your whole business, continued performance is going to give you a higher multiple or a higher sale price for your whole business. So you want to see continued performance in that. More so in other industries, but when we're looking at doing a business purchase, if someone, what we'll often see is over 3 years, we'll see no profit, no profit, big profit, and they want to sell it on big profit. Well, anyone doing their due diligence is not going to buy on big profit because it's only 1 year of performance. So you want to see that consistency in performance.
So how long then should you plan out if you're wanting to sell your rent roll? Because that's hard then, because then you're getting hit with massive tax. So
Yeah.
where's that sweet spot for business owners?
That's a great question because the answer is how long is a piece of string? The ideal is that you're going to be sale ready at any given moment. Because if you are sale ready and something happens in your life that says, I have to change what I'm doing for health reasons, or have to move overseas because your partner's going, your parents are sick, whatever it is, something in your life changes and you need to sell. You don't have 18 months to clean up your financials, get your performance ready to go, and then all of a sudden I can sell. Like if you need to move and move quickly, and these things don't move in a month, they move in between 3 to 6 months by the time you engage the purchases, those due diligence, etc. But you want to go straight to a real estate broker and go, hey, can you sell my business for me? It's ready to go. It's schmick, numbers look good, bang. If you don't have yourself sale ready from day one, it's going to make it a lot harder. That's the ideal scenario. But in a planning sense, if you can plan at least 2 years out, right, I'm retiring at 60, I'm 58, I want to be sale ready at 60, 100%. That over those 2 years, you're doing everything you can to make sure that the performance is schmick, and then it continues on all the way through. But the ideal is always be sale ready now. So if your business is running at a loss, I'd be going through everything now, or your fees, or your expenses, or things you can cut, things you can add. Are you taking too much money out of the business? All those different things to try and improve that performance, and then working with your accountant to ensure you can reduce that tax at the same time. Because as you said, it is a balance between paying tax and reducing that load versus actually trying to get some money or making it look like it's sale ready at any given moment.
So can you maybe that's absolutely fantastic advice. And I think you're right. That is, you just don't know what life's curveballs are going to throw at you. I see so many people scrambling with their due diligence and their rent roll audits when it's too late, when they've already got a contract. And then it's so much stress and heartache. And I've been there myself. So I'm speaking from experience. But what are the actual, or can you break down what a healthy rent roll looks like for sale?
Yep. So within the rent roll itself, the property managers and the owners will know the actual rent roll better than I will because they're in the industry every single day, seeing the clients and whatnot. But behind the scenes, when you're looking at what's going to make a saleable asset, you're looking at things like your management fees. Are you charging properly? Are you on top of it? Are you at market? Are you over market? Are you under market? Different states have a much higher multiple, so much higher management fee. Other states have much lower. So there's a certain area of Melbourne which is a lot lower than other areas of Melbourne, driving lower multiples. So your management fees. Number two, your ancillaries. Are you actually charging your ancillaries? Yeah, they're all on our agreements, your statement fees, your inspection fees, all these different fees that are associated with the lease. Are you actually charging them? Because you might look at that and go, okay, it's just $1 statement fee. But if you have 500 properties and those clients are doing one statement a month, that's $500 a month. You're missing out 6 grand of your bottom line straight away. Now, 6 grand in real life terms probably converts to something like $70,000 or $80,000 borrowing capacity. So that can make a big difference on what somebody can borrow for your business. Just a pause on that is the banks won't take into account your ancillaries for a security value, but they do for servicing requirement when it's buying a business. And so how you're charging your fees properly. Are you overstaffed? Are you stripping too much money yourself? Are your wages exorbitant and therefore leaving nothing in the business? So you want to be looking at that as well. Because yeah, you can play with that for a tax point of view, but if you take too much money out, you're stripping it out, then it's actually going to affect the business itself. And you might run too skinny in other areas. So you want to make sure you're on top of that as well. In again, back to the rent roll itself, looking at your arrears rates, your vacancy rates, your stuff. So all of those in behind the scenes make up a strong rent roll. And then off the back of that, that translates into your profit loss. If you have 10% vacancies, you're not earning money off that. They're actually costing you to hold them while you're still out listing and seeing people and trying to show people through on opens and whatnot. So the arrears, your staff are spending way too much time chasing arrears. So your costs are going to go up, staffing, or your efficiency is going to go down. Therefore, your BDM activities will suffer because your people on the road trying to fix arrears rather than actually going and getting new properties. So there's just a few of many different things you can look at from a property management department sense, which will then increase your profitability or efficiency, which will then lead to your profitability.
So what are the numbers that you see or that you are witnessing in the current market? What's the sort of standard percentage for profitability or the standard amount? There was an old rule of thumb where your property management department covered, was it 70% of your operating expenses? And what percentage should your wages be? Have you got any numbers there that you can share with us that you're seeing or that we should be aiming for? Because I think nobody really talks about that. There's not a lot of conversations around what is a healthy profitability or how much should you be spending on your wages? What's too much?
Yeah. A lot of those rules are changing significantly. Absolutely. Those numbers are 100% correct. If I'm honest right here and now, I don't have a number on the wages one, a percentage, because
That's fine.
again, the wages in each state are moving around and changing significantly, but it clearly is the percentages are different. But what I can tell you is that the management fees on your rent roll are significantly different state to state. And so if we're seeing significant, which is bizarre in some sense, because Victoria's probably got one of the lowest in the market versus WA is higher, but the standards that are required for Victorian properties are a lot higher than other states. So you should be charging more to actually compensate you for the time you're putting into that.
Absolutely. That's crazy when you think of it like that, isn't it? I hadn't actually thought about that.
It's absolutely ridiculous.
Yeah.
Sorry, go Kylie.
No, I'm just like, that penny just dropped for me. That's absolutely true. Yeah. Victorian compliance is crazy, and yet it's the lowest fees.
It's insane. And some of the portfolios that you see, so they're running it. I'll use an example I know in the west of Melbourne. I won't mention clearly agencies and who and where and how, but the average management fee across their portfolio is 3%. How do you make money on 3%? Now, I look at it from the outside.
I wouldn't get out of bed for that.
So I look at that portfolio and I go, that particular owner surely has purchased a rent roll with the aim of selling it. So if they can get it, just pay a low fee, it doesn't really matter. They just get all the different sales that come through it. Therefore, they're going to make their money back, which is counterintuitive in some sense because, you're actually buying these things to then sell them, but you may not make money off them, but it's costing you too much to hold them before you sell. It just doesn't make sense. But that's the only mentality I could think because otherwise it's a race to the bottom. At 3%, that's what I was saying, it varies from state to state. So if you're in UA, I think the average is about 8.8 or 9%. Whereas in Victoria, it's probably around 5. So if you're in Victoria and you're at 5%, you're paying a PM the same as someone in WA. Percentage-wise, that's a lot more of your profitability than in WA. So we're seeing large disparities from state to state in some of that, which is then leading on to some really strange mindsets behind some of this. Look, I understand it's dog eat dog. Everyone needs to make a dollar for themselves. But when you keep pricing your management fees down, it's race to the bottom. So yes, the wages is too hard at the moment. There will be a national number. I just don't have it on me, but I couldn't. Yep. But it used to be the 70%. Absolutely was correct. Typically, we're seeing around a 35-ish % profitability on companies, a net profit margin from top line to bottom line. So what I mean by that, if you've got $1 million of turnover, $350,000 is your profit. And that's before director's fees. And then you might take things out, director car, and your accountant plays with that number. It doesn't always equate to that clearly. That's just like a rough average. And again, that's in Melbourne with lower fees, with higher staffing costs, with higher compliance costs, and they're still doing low management fees. By the time you move up to the Gold Coast, it's a higher percentage than that. On average, we would expect to see. But again, it's dependent on what your management fees are, your wage costs are, and your efficiencies behind it.
Yeah. Tell me and this is just a question I just typed out before. I was thinking about it because there seems to be lots of people acquiring rent rolls at the moment. Yeah. And I was just wondering and how this would work in terms of financing rent rolls. If I'm in Queensland and I saw an opportunity with a rent roll that was only getting, and for my mindset would be if I was getting 3.3%, I would be turning that business around to getting it up to 6 or 7% management fees.
Yep.
How does that go by? And I'm sure there's other people that are already buying interstate, and I'm sure it's possible. But is it possible to I'm in Queensland and I want to buy a rent roll in Victoria and run it from Queensland?
Absolutely. 100% it is. I've got a couple of clients who are currently doing it and a couple more who are looking into it for the sole purpose of that exact thing of, hey, I'm in Victoria right now. My management fees are so low here. Why don't I buy one up north? And then I go and run it at a higher multiple. And that's a higher management fee, then therefore higher multiple sale price when I do retire and whatnot. Clearly, in behind that, you need to have the infrastructure on in the state. So whether it be that you've got contractors, whether you've got an office, whether you've got presence yourself up there to do that, it does take a special business to be able to manage that because it's hard enough running one in one state on your own in your own territory with your own legislation. To be across multiple, you really need to make sure you're across those and having good partnerships with your accountant, your broker, your inspection expresses, your tarpies, those guys across different states to make sure you're up with the legislation as well as obviously the licensing bodies. You will need a license in each state. You can't operate in Queensland under a Victorian license and vice versa. So those clients that have done that have multiple licenses in multiple states. Can it be done 100%? Is it difficult? Yes. So you need to make sure that you've got the right advice behind it. In that, the most successful ones I've personally seen are when you've got a presence in the state as compared to having just total remote management. But some people are doing things remotely as well.
Yeah. So if someone wanted to finance for growth, so they've grown successfully organically and now they want to work on some acquisitions, what do they need in place first? And I'm assuming they've got to have evidence of being able to grow organically first and foremost. Or is that not something that the banks look at? Yeah. What needs to be in place first?
Yeah, it depends on what their process is, right? And what their goals are and how they're getting there. The whole conversation to start with why, where are you going, how have you done it, why are you doing that sort of stuff. But if you've got a rent roll you're growing organically, we don't have to show if you've done it over 10 years or 2 years. We just get to a number and go, that number is sustainable, or we're able to use that as some sort of leverage to grow. So as an example, if you came to me and you've been operating for 12 months and you have 10 properties under management, and then you want to go buy 100, whatever it is, I'm just using those numbers for a random, we're probably not going to be able to leverage, but we won't be able to leverage a current one because it's too small to go buy that one. But then the cynic in me says, you've been operating for 12 months, you've only got 12 properties, 10 properties on. How are you going to be able to manage 100? Like you haven't managed these ones, potentially, right? That's the cynic. So we ask more questions and find out why and how, but the cynic in me does have that. Because the first thing of any deal is the 5 C's of credit. Well, the first one of 5 C's, every single deal, home loan, car loan, rent roll loan, doesn't matter. The 5 C's of credit come into play. If we have time, I'll circle back to them later. But the first one is character. So who are you? What do you do? What's your history like? How long have you been in the industry? Do you have tax debt? Do you strip money from your business? Can you manage a business? Can you sell, etc.? So if you have been doing this for 12 months and you've only got 10 properties after 12 months of effort, I'm going to character and going, are you the right person to be buying a rent roll of this size, or do you have some growth to do first? However, if you come to me after, say, 3 or 4 years and you've got 100, 200, 300 properties, 50 properties, whatever it may be, if you've got the history of profitability behind it, we can go, okay, you might only have 50, but you've managed it well. You don't have arrears, you don't have vacancies, you don't have issues with staffing, and you've got profitable numbers. We might better leverage that to go and buy another one. So I suppose on that organic growth question, it does allow you to scale quicker, but it takes longer to get that base. So if you can get 200 properties over 5 years, bring in a BDM and start growing 200 properties and it's fully organic, therefore your 200 properties, because we can lend up to 70% against rent rolls, combined of your new and your old one together, your total value 70%. So if we have 200 properties, just to make it 300 for round numbers, 300, if you've essentially is going to be about a 30% deposit, roughly. So if you have 300 properties, in theory, you can go buy another 700 and go from 300 to 1,000 with one transaction based on the deposit aspect being covered by existing equity in your rent roll. But if you've got 10 or 20, you're not going to have that scalability than someone who's grown a little bit more organically first, if that makes sense.
Yeah, yep, no, totally does. So let's just touch back on those 5 C's of credit.
Yep. So every single transaction in our space, whether you think it does or doesn't, covers 5 C's of credit. There's 6, 7, 8, 9 versions now, or 6 C's, 7 C's, 8 C's. But the core 5 C's of credit are the character, capacity, capital, collateral, and conditions. So every single deal we look at now, if you have a really straightforward car loan,
a lot of people may not know this, but if you own a property, even if it's in your partner's name, register for GST, and you've been ABM registered for 2 years, and you've got good, clear credit history, I can just get you a car tomorrow up to about $200,000. No financials. You just call me. We just tick off that you're done, and away you go. So whether it's as simple as that, or whether it's a complex rent and roll purchase, complex business loan, self-managed super fund, partnership buy-in, doesn't matter. Whatever the deal is, those 5 C's of credit are covered off in every single transaction. So the first one is character. So we spoke about that one before.
Yep.
So that's about the person, the history. So if you come to me, you've never done real estate before, and you go want to buy a rent roll, you're going to have to prove to me you have some pretty significant management experience, organizational experience, resilience from other roles you've done, or maybe another business you've owned before we'll consider it. Because I can spend weeks with you, put it all together and give it to a bank. And the first thing they're going to say is, do they have experience? Doesn't matter how strong everything is. You could be buying, let's just say, the likes of a Housemark or an Exceed or some of those big businesses. You could be buying that. If you don't have experience, you are not getting that finance without some pretty stringent conditions with other partners. It's going to make it so hard. So that's what character is about. Second one is your capacity. So your capacity comes down to, can you afford this? So that is where your financials come into play. That is where I can describe it as the top-down, bottom-up method the banks use when they're servicing. Okay, so the top-down is, we look at your business. If you're buying a rent and roll, doing a car finance, whatever it is, we look at your business and go, what is our profit behind the business? Profit is X. Then we look through the financials. Is there anything that we need to add back or take out? So for example, if you've got depreciation in there from something, that's a non-cash expense. We can add that back in because you're not physically paying it out. It's the book value. Interest we add back, so we don't want to be double counting loans. We're then servicing your car loan in there, but we haven't added back interest. We're actually double counting debt, so we add that back. If the staff members moved on and you haven't replaced them for some reason, if you've moved offices for a cheaper lease, if you've done that sort of stuff, we then strip all those expenses out because they're not ongoing. Or it might be in your case, Kylie, you sold a business, so you spent 10 grand with a solicitor. We're taking that out because that's actually not part of your ongoing expenses. On the other side of the equation is non-recurring income. So in your case, Kylie, if let's just say your training and your coaching is all under the same banner as your real estate rent and roll, say the same company, now that you've sold the rent and roll, we have to take that income out. So that income's no longer in existence, and therefore all the expenses associated will take that as well. The most common one we see that we pull out are sale of assets. So you've sold a car, so you made a profit on a car in the business. The other one we regularly see is interest, and it's not bank interest. It's interest related to Division 7A loans on your balance sheet, which I won't go into too much detail of because that's an accounting thing. But when you strip money from your business and it's not counted as a trust distribution or a wage, it therefore sits on your balance sheet as a director loan that you've pulled out as a director of the company, and you've got to pay that back over X amount of years. Your accountant will advise you on that, and you have to charge interest as per law. So we often add that. We need to add that back as well. So after we've taken your net profit and adjusted everything accordingly, we have this number. So from the top down, we go, does that number, which we call the adjusted EBITDA, which is the adjusted earnings for interest, tax, depreciation, amortization, we take that number and go, does it service all your debt in the business? The answer is yes. Fantastic. Then we go down to your personal scenario and go, does the money left over after everything's accounted for the business, all that money left over plus any wage you pay yourself or your partner has, because they're probably external to the business, but they still contribute to the family. Do you then service all of your personal debt? If you get a tick there and a tick up there, there's a deal, because you can service in the business, you can service individually. If the top one says no, but there's enough surplus in the bottom one that we can shove some money back in the business, then we're all happy. So that's what we're talking about. Top down, we start with the business, we go individually. And if we're short one way or the other, then we have to make sure we can pull money up or down between company and yourself at those different tax rates. And if we can then get the whole thing to service, then we've got a deal. So that's capacity. Capital is all about your position. So not about your experience, but your actual statement of position. Do you have property? Do you have cash? Do you have shares? Do you have super? Essentially, if they're going to give you $1 million to go buy $1 million asset or a $1.2 million asset, depending on where you're at, they want to know, are you savvy enough to be able to build something for yourself? Are you putting money away? Have you bought a house? Have you got something behind you that if something goes wrong with this deal, they have to sell the asset, and they've got to enact their director guarantees, which we'll get to in a second? they've got something beyond it. So if they sell your rent roll for $1 million, but you owe 1.1, where is the extra 100,000 coming from? Do you have the capacity to sell some more assets down and clear it back? Or do you need to go and get a job and pay the back over X and out in bankruptcy and things like that? So it's all about you behind it. And this is where they also call hurt money. So you don't expect a bank to give you 100% every single time. That's why they ask for deposits, because they want your skin in the game. So 100% on a rent roll won't happen unless you put in hurt money, which will be cash, or to get 100%, your current rent roll is your hurt money. So therefore, you're financing 100% of the new purchase, but the overall transaction is only 70%. But that's your hurt money. So that's, again, under that capital banner. Fourth C is collateral. That is security. So every single deal we have has a security structure. In a rent roll land, we're looking at the rent roll as an asset is secured by the banks. They'll register a charge over it. They'll also register a company charge, so basically a mortgage on your company, to make sure if something happens to the asset, they can take hold of that to make sure it keeps trading. Because we said before, it could take between 3 and 6 and 12 months to sell your rent roll. So if something goes wrong in the background, you can't pay your debts, they want their asset protected because that's the security. So they can then come in and enforce and help run that whilst they're trying to sell it. They'll take a director guarantee from every director. Doesn't matter if you're a silent partner, if you're a director, it's extremely rare they'll let you off without a director guarantee. So all directors are guarantees. And then there's shareholding guarantees as well. If you're a minor shareholder, usually there's no shareholding guarantee. But if you're 20% or more, you're 9 times out of 10 a guarantor of the transaction. Because at the end of the day, the directors run it, but the shareholders own it. So they then capture that structure. So that's your collateral. So what is securing behind it? And that's why they keep it under 70% as an overall basis. But then they've always got a little bit there. They've got 30% reduction, whether you've stuffed up and not got too many arrears, too many vacancies, too many landlords have left during retention period, whatever it might be, that all of a sudden you're less than, what you said you were. You've got plenty of buffer in there to still protect the asset. And the final one is conditions. And conditions is all about how you're going to interact moving forward. Do you have to provide financials every single year to then do an annual review to make sure the books are correct and the asset? Because remembering, this is not a physical asset. This is not something they can take to market tomorrow and auction it off and get money. This is what we call a cash flow asset. To us, we are in the industry, we know really well. It's got intrinsic value to every agent out there, but it's not bricks and mortar. It's not available to everyone to buy. It's available to a specific industry. And the reality is, if you pull a shifty, if you don't do your management agreements properly, all that sort of stuff, your assets worth zero, because the cash flow is what comes from that. And if there's no cash flow, there's no asset. That's a cash flow asset. So the conditions, yes. So you look at annual reviews. That will often be tax, keeping up to date with your tax, making sure there's no tax plans in place with the ATO. Accountants have typically loved using the ATO as a bank. Don't pay them back. It's fine. Just payment plans. Banks hate them. And the number one reason they hate them is because the ATO will rank above them in the charge. So if something goes wrong with your business,
Gotcha.
and it's going to go bankrupt and they've got to sell, and they sell your rent roll for $1 million, and they've got a debt of 1.1 million, who is getting the first lot of money? Not the bank, it's the ATO.
Gotcha.
So if you owe 200 to the ATO, that $1 million they got is only now worth 800, and they've still got 1.1 outstanding. So the ATO takes first charge. And then a recent change as well is that any ATO interest is no longer tax deductible. The ATO's changed it because they're sick of not being paid. So rather than having 9%, 10% interest charge in there and having it tax deductible, they've removed that. There's no need to have tax debt now. There are no advantages to having tax debt because you're going to charge interest that's non-deductible, and then it affects you to try and get. I understand there's periods of time, maybe just short periods, but long-term tax plans are gone. It's not a smart idea, and nor is it the way for the banks. But speak to your accountant before you speak to me on that one.
Yeah, I know. And
I need to advise.
I've spoken to a lot of people, and in my own experience as well, the ATO have got really quite nasty now. So any of the number one financial I would advise from my experience is get your tax planning sorted when you're starting out your business. Put that tax money aside. Don't even forget that's part of your business. Put it aside, pay it, and then work on your business around that. That's
absolutely. There's two rules behind that. Sorry, Carly, is that there's two parts to it. And this is where the banks look at these things and go, there's income tax and then there's GST, PAYG.
Income tax, in my experience, when you're looking at income tax, banks tend to be a little bit more flexible on having outstanding income tax, not overdue, just outstanding. Because if you lodge it in, say, October, you don't have to pay it till May, or you don't have to lodge till May. That's just how it works. But that number does change depending on how you end up doing your numbers with the ATOs. They seem to be a little bit more flexible in how they look and see income tax. They won't let you have it overdue. They'll have it if you do go to the bank and say, I've got overdue income tax, they'll want you to pay it out before you settle the deal. That's fine. But there's more lenience in that space because it is an unknown number until the whole year is done. There are prepaid things in place with the ATO now, but that's not my realm. But they're more lenient. When it comes to GST and PAYG that you need to pay for your staff, that is not your money. So the banks get super frustrated when someone comes in and goes, "Hey, I've got $100,000 of GST owing, and my turnover for the year is 50." Hang on, that's $100,000 turnover. Sorry, 500 at 10% is 50. Why have you got 100 owing? Oh, it's been on payment plan for a couple of years. It's been accruing. I'll deal with it. No, that's not your money. For every dollar you receive, 10% of that is the ATOs. So you should be putting
unfair,
10% aside. It is. That's absolutely unfair.
That's topic for another day. Yeah. Sorry.
It is 100%. And one of us will get in trouble with regulators. It's right. That's the reality of business, though. But 10% of every dollar that you've got is the ATOs. So when you get in $1,000, put in 10% to a secondary account. If you can run your business minus 10% every single week, every single month, you're never going to be wanting your GST payment. And at the end of the year, when you've done all your cycles, you're going to find you're going to have a fair bit of surplus because the 10 cents of every dollar you spend is back to you because of the way the GST works with offsetting it. So if you can afford to do 10% aside every single month when you do your commission runs, we'll keep it over there. You're never going to have any issues. If you can't do 10, do 5, do something, because otherwise you're going to have these bills every quarter. You go, where's my cash gone from? Because you haven't managed it, it's not there. And the other one is your PAYG. Every single time when you pay your staff, zero, reckon, whatever it is, there's a number here that says this is how much a PAYG, and now super is obviously more regular now with the new rules, but this is how much you owe. So you need this. We'll take that money and stick it in the account because that is not your money. Again, we can argue whether it's right, wrong, or indifferent, but that is not your money. So if you have 100 grand in wages for the year and $20,000 that is tax, you should have $20,000 sitting there on rotation throughout the year to cover your PAYG bill because it is not your money. That 100 grand you're allowing for your staff is 100 grand out of your bottom line, but 20,000 of that is not yours. It's the ATOs. So why are you spending it? And then you get into this spiral and you can't catch up. So the earlier you plan that, the earlier you implement to your business, even if it's not 10, start with 2, start with 3. Implement something like that in your business so you can always have something waiting. And then at the end of 12 months, you'll realize, hey, I've got too much. I'll take some of that cash back into the business because then at that point, you've had full 12 months, you can work it out. But yeah, early tax management is key.
Absolutely. That you've just shared some super valuable advice there. I think anyone listening, that is the best advice I've heard in a long time. And I wish I had been given that when I started out in my business. So thank you so much for sharing that. I've got a bit of a closing tradition on the podcast where I get you to leave a personal development tool, book, resource, something that you feel would help our audience and our audience very well. What can you recommend for them, or what's something that's resonated with you recently?
Oh, that's quite a loaded question because I read a fair bit of books and listen to a lot of podcasts because I was on the road. But there's 2 books that I'd recommend reading. One was recommended to me by Sophie Anapliotis down in Geelong, Melbourne, Element Property, and she recommended to me The E-Myth by Michael E. Gerber.
Yep.
So that's all about systemizing your business, making sure in the background things are happening. If somebody walks into your business, they can just go with it. You can do some training, but it's not always relying on you. It's systemized. It's how the likes of McDonald's and those guys have gotten so big. You can go somewhere in California or somewhere in Melbourne and the burger's made the same way. Maybe not looking the same, but the process is the same. So the E-Myth Revisited, we're in the process of redoing all of our systems and processes, and they're so different from 6 or 8 months ago. So thank you, Sophie, for that recommendation. The other book that I personally love, and it's because I'm a bit of a storyteller, I like talking if you couldn't tell, but a bit of storyteller, it's called Made to Stick by Chip and Dan Heath.
Okay.
And that whole book is all about how do you get your story across and how do you get your story to stick. So it talks about doing things and like when you're talking, do it in stories, the unexpected, do concrete facts. So all the stuff today we've spoken about, hopefully, because I've put numbers on them or put a story behind it or put a name behind it, people remember some of these things in a year or two going, what was that podcast? Rather than just airy fairy stuff. It actually sticks because you've stuck to that. So Made to Stick by Chip and Dan Heath would be the other one. Really easy read. I read that nearly 20 years ago and it still sticks to me today.
Amazing. Thank you so much for sharing. And how can anyone listening reach out or find out more information, all things financial, rent roll, broking from you?
Yeah, absolutely. Thanks, Kylie. So there's a couple of different ways. Obviously, you can see up here the Rent Roll Finance Broker. So that's our tag on Facebook, on Instagram, LinkedIn. You can find me, Travis Whelan, on Facebook, Instagram, LinkedIn, all the above as well. So feel free to reach out on the socials. Our website is therentrollfinancebroker.com.au and my email is travis@rentrollfinancebroker.com.au. It is a bit of a mouthful, but it's a great SEO play. But yeah, that's what we specialize in.
Yep, I'm all about the SEO play and the AI search play now as well. So
yes, I'm learning that at the moment. So I'm trying to tweak some things, but I'm leaning on some experts in that space. And I've seen your presentations a few times, Kylie. So it's just always getting me thinking in that.
Yeah, it's the future, isn't it? Travis, thank you so much for joining me. I am super grateful for your conversation today and all the value that you have shared with everyone.
No, thank you so much for the opportunity, Kylie. I love it. And if I can help any of your listeners, I'd love to be in touch and just at least point them in the right direction.
Can I ask you a quick favour before you leave this episode? Now, we all know how important reviews are for businesses these days, and mine is no different. If you could spare just a minute to follow, rate and review this podcast, it would mean a lot to me. In fact, what would get me super excited is if you share this podcast with someone in the industry who you think might need to hear some of the episodes right now. And if you'd like to find out more about working with me or any of the products I have to help you start, grow or scale your property management business, head to my website, thatpropertymum.com.au, or check out the links in the show notes.